everyone, welcome to the Wealth Doctor TV. If you are new to my channel, click the subscribe button below to become part of the family. And if you are a returning subscriber, thank you so much for your love and your support. Now, today is episode 4 of the investment series special. So on my channel, I normally post videos on Monday and Thursday. On Monday, it's all things money, personal education, everything that is related to money and chalata. We speak about it on a Monday, and on a Thursday we speak all things personal development or conversations that can contribute into you evolving into the best version of yourself. However, right now, for a 10-week period, we are running an investment series special where every Monday and Thursday we speak all things investment, because I want to break down investment for you and unpack them so that you can understand, because investments form a huge chunk of your wealth creation. It's very important for you to understand what you are getting yourself into, since this is the determinant or the biggest determinant of your wealth creation process, hence why it's taking 10 weeks. All right, so let's get right into today's video. So today's video, I'll be explaining what bonds are. So bonds are part of the 3 types of common investments, which are your shares, your bonds, and your money market instruments. So I've already done videos where I explain what investing is, where I explain investing in shares, and I compared ETFs and unit trusts. So if you haven't watched those videos, please go back so that you can catch up and know what we're talking about in today's video. So today we'll be talking about bonds, like I said, and I'll be taking you through 4 things. And the first one is what bonds are. Secondly is the risks that are involved when buying bonds. Thirdly, it's what you need to look for when investing or buying bonds. And the fourth one is how to invest in bonds in South Africa. So let us get right into the video. So what are bonds? That is the first point that we're going to discuss. What are bonds? So bonds, it's pretty much you giving a loan to the bank or a company so that they can fund a particular project. And obviously, you know that when you go and borrow money from the bank, you have to return the money with interest. Same thing happens when you borrow money to the bank, or when you lend money to the bank and a company, you also expect to receive some money in return. So you can't just give people your money for free, especially because bonds are expensive. You can't just be dishing out millions for free. So obviously you expect something in return. So what happens is you are going to lend a bank or a company some money that they are going to return through interest payments, and at the end of the period they're going to give you interest plus your money back, because it's a loan. You were not giving them the money. So how a bond differs from shares is that in a share, when you give the money to the company, or when you buy a share, you are actually buying ownership in the business, whereas with a bond you are not an owner. So if the business is making losses, it's not going to affect you, same as if the business is making profits. That has nothing to do with you. You just lended them some money and you expect to get your returns back. So how are those returns paid? They paid in things called coupons. So when you buy a bond, they're going to tell you that you're buying a 1 million rand bond with maybe, for example, 5% coupon. So you're going to receive that coupon every single year. So every single year, you're going to receive 5% of the money that you lended to the company or to the government. And money that you lend to a company is your corporate bonds, and the one that you lend to the government is your government bonds. So let's say right now you lend the government a million rand, and they tell you that you're going to receive 5% coupons. It means every single year you're gonna be receiving 50,000 rand. So let's say maybe you borrow the government the money for 10 years. It means that every single year for 10 years, you're going to receive 50,000 rands from you lending them the money. So overall, at the end of the period, you would have made 500,000 in returns, because 50,000 times 10 is 500,000, plus another thing that's guaranteed is you are going to receive the money that you initially lended to them, so your principal amount. Whereas with shares, it's not guaranteed that you're going to receive the money that you put in the company. So in with shares, it's just you putting money and hoping for the best and praying that the company is going to do well, but you don't know how it's going to do. Then with a bond, not saying that you know, but it's a legal contract, so you are liable to get your money back. And if you don't, you are allowed to go and sue the company so that they can sell their assets and pay you your money back, because this is your money and you're not an owner and you have nothing to do with the company. You don't receive dividends with bonds, but you receive coupon payments. So now bonds are a good way to preserve your money while making an extra return. So the returns that you will make from a bond are not as much, but you're still going to make returns. So it's good for you if you want to store your money but still make a little bit of money on top of that money. So with the example that I gave you of 5%, 5% is not a lot of money compared to you buying stocks of a company. Maybe when they initially issue out the shares, you buy the stock for 10 rand, and then in 10 years it grows to 1,000 rand per share. So as you can see with bonds and and stocks are going to bring you more money, but they are riskier because you don't know what the future holds. Whereas with bonds, they are less riskier, but the returns are smaller than that of stocks. Why? Because it is guaranteed that you know how much you're going to get in terms of your coupon payments. With stocks, you don't know how much dividends you're going to get, because you don't know how much profits the company is going to make, or you don't know whether the company is going to make profits or loss. And another thing is with bonds, it's guaranteed that you're going to receive your principal amount back, so the money that you lended to the bank or the company. So it is guaranteed that you're going to receive your money back. Whereas with stocks or shares, you don't know whether you're going to receive it back and whether you're going to receive it with capital growth or with a loss. So that's another risk. And then the third thing that makes a bond less riskier than a share is the fact that a bond is a legal contract. So if the company does not pay you back your money, you are allowed to take them to court and make them pay back your money. Whereas with a share, if your fund or your investment makes a loss, you don't have a right to take them to court and sue them, because you are part of the owners. And as part of the owners, you benefit from the profits and you also lose from the losses. So that is the difference between shares and bonds. And also, that's how bonds are less riskier than shares. Now, moving to the second point, of which is the risks involved in you buying bonds. So there are two types of risks that you can get exposed to when investing in bonds. And the first type of risk is default risk. So that is the risk of the borrower defaulting on payments, or the borrower not being able to pay you the money that they're supposed to pay you. So you buy the bond, and then now the people that you borrowed the money or that you bought the bond from do not have money to pay you back. Whatever it is that they were going to put the money in does not bring the returns that they calculated or anticipated, and then you end up losing your money because they are not able to pay you back. That is default risk. And the second type of risk is interest rate risk. Remember, when you borrow the company or bank money, you expect to receive interest in the form of coupons. So if the interest rate goes up, it means it will be higher than your coupons, which means it makes your bond less attractive. And if you want to sell it, there's not a lot of people who are going to be attracted to it because of interest rate risk. So you also face a risk of interest rates rising over the time, especially if you buy a 10-year bond. You know anything can happen in 10 years. So those are the two types of risks that you are exposed to. The third point is things that you need to look for when investing in bonds or when buying bonds. So the first thing that you need to look for is the credit worthiness of the company or the government. So a credit worthiness is pretty much for you to determine if the government or the company is in good financial standing. And remember, when we were speaking about the risks, we said the risk of defaulting. So if a company is not in a good financial standing, it means that it is more likely to default on payment. So they might be able to pay you maybe for the first 2 to 3 years, and then as time goes on, they're not going to be able to, because the company is not in a good financial standing and it can go bankrupt. And the thing that determines, or the tool that you can use to see if a company is in a good financial standing, is the company's credit rate. Now, the 3 companies that determine your credit rating are Moody's, Fitch, Standard and Poor's. So if a bond is from AAA to BBB, so they have a rating where it's AAA, AA, BBB, BBB, CCC, CCD. So if a bond is from AAA to BBB, means that, if a company is from AAA to BBB, or government is from AAA to BBB, it means it is in a good standing and there's less risk of the company defaulting on payment. And the other ones below BBB, so from BB to D, and D, which is the most riskiest, means that you are gambling with your money, because there's a possibility, if not a guarantee for you, that you're not going to receive your money back in the long term. So you have to determine the credit worthiness of the government or the business that you are going to invest in. And the business with the lowest credit rating, or within a bad financial standing, is the one that offers higher returns. Why? Because they want to attract investors to invest in the particular project that they're trying to fund. So in as much as, yes, they can be offering you a high return, it's very important to consider that their credit rating is bad. So there's a very huge chance that you are going to lose your money, or you're not going to receive your principal back. So in as much as the good companies are offering you a lower interest or coupon, but you know that you are going to receive your money back. Second thing that you need to look at is the yield, which is pretty much the interest that you are going to receive from buying the bond. So like I said, the higher the yield, the higher the risk. It means the company is in a bad standing and you need to be careful, or you need to prepare your heart for the worst. And the lower the yield, the more credit worthy the company or government is. Now, moving on to the 4th point of how you can buy bonds in South Africa. So we have 3 ways in which you can buy bonds in South Africa. And the first way is you can buy a bond exchange traded fund, or you can buy a bond unit trust. And I've already done a video where I explained the difference between an ETF and a unit trust, and I'll link it below. And then the third way is you can buy individual bonds by registering on the bonds website, the South African bonds website. I'll also link it down below. Or you can buy them from the post office, or you can buy them from the bank. Now, here's the advantage of you buying bonds through an ETF and a unit trust, is because they are more affordable, especially because bonds are more pricier. Bonds can go to like 100,000 rands, they can go to like 1,000,000 rands. So not all of us can afford to just take out 1,000,000 rands and invest it in something that has the potential of someone defaulting on the payment. So ETFs and unit trusts are very affordable, because with unit trusts, they normally start from 500 recurring payments, or 10,000 rands once off. And then with ETFs, you can buy it from as little as 1 rand or less. So it is a very affordable way, and it's also diversified, because if you do not have experience on bonds, or you are not a bond expert, you don't know which bonds to go for, you don't know how to interpret a company's credit rating, and you don't know how to compare it to the yield. So you buying an ETF and a unit trust is something that is already done for you and packaged for you, and on top of that, you get to purchase it at a lower price. So now, if you enjoyed the video, don't forget to like, comment, share and subscribe. Share, comment down below if you bought any bonds, or if you would be interested in buying any bonds, whether it's through ETFs, unit trusts, or individual bonds. And thank you so much for your love and support, like I said. And if you are new, subscribe. You don't want to miss on the investment series. We're already on episode 4, so go and catch up, then subscribe so that you don't miss out on the remaining videos. Now, thank you so much, guys, for your love and support. I really appreciate it. Like I said, don't forget to like, comment, share, subscribe, share with your friends, my families, and friends, and families, and friends, and families. I'm sure there's an uncle who'd like to preserve their income while earning extra money. So share this video with uncle, or uncle, there's a girl who plugged you with information on bonds. This is a gift from me to you and to your uncle, so that you can invest in bonds. Now, thank you so much. I'll see you on the next video. And hey.